What did the analyst community in general, and I'm not saying you because you have an outperforming on Morgan Stanley, get wrong?
So I think you look at the backdrop for the third quarter and you had a number of things that I would say were headwinds. You had the interest rate pressure, you had the macro, kind of the trade war, which I think created some uncertainty and affected business a bit. And then just overall, you have some seasonality in the third quarter. So I think everybody lowered the bar as kind of the quarter went on, as the backdrop seemed pretty difficult, and obviously Morgan Stanley exceeded that. So I would say that we were only 2 cents away from what they reported, so we were pretty close, but ended up being a little bit better quarter than I think most people expected.
And all credit due to JMP. But let me ask you how the interest rate spread worked in Morgan Stanley's favor. I mean, short term versus long term, it really wasn't much.
Yeah, so I think they actually talked about it on the call. The go forward is going to see a little bit of pressure from the interest rate curve. So you didn't see much of it this quarter in results, but going forward, you will see a little bit of pressure on net interest income. The good news is equity markets moved higher, so that will offset some of it. Deposits, customer deposits moved higher, so that will offset some of it. And then I think we got a pretty good investment banking outlook out of them as well. There's a lot of uncertainty around the trade war, and as we get closer to the U.S. election, how does that affect corporate sentiment? But for all things considered, they did still talk about backlogs being healthy and that they feel good about the M&A pipeline and equity underwriting pipeline. So I think that was encouraging too.
Devin, good morning from London. Net interest income looked pretty good. Lending looks pretty good, i.e. that number is higher because of that. Does that get sustained? The consumer is looking good right now. How sustainable is that?
Yeah, it's a great question. I think, as we were saying, the actual interest rate piece is going to be a headwind. You think about, the 2 Fed cuts that we've already had. Some of that was kind of rolling through results throughout the quarter, so you didn't see a full quarter impact of those 2 Fed cuts. And then the question is, how many more cuts do we have from here? To the extent there's more cuts, I think that will create a headwind. But you're right, on the actual lending side, they were pretty constructive around the ability to continue to grow loans, and that's a nice offset. And then what happens typically is when markets are a little bit more volatile, and you could say we're in kind of a period like that right now, is people move more of their money into cash. So the deposits, which are in their bank and wealth management, they can actually leverage and make some spread on that as well. So on one hand, you have the actual yield curve flattening or inverting, but you're seeing deposits increase, and so that's providing kind of a nice offset to the interest rate headwind. So there's some puts and takes there, but on balance, you kind of mitigate a lot of that net interest margin pressure.